Hey guys, it's that Dividend guy coming at you with another Robinhood portfolio update. Happy Monday. Hopefully everybody's having a GGD, a great green day in the market. You know, I always wish the best for my viewers and subscribers. So for today, we're going to go over the overall portfolio value. Of course, the value by the metrics, see how the portfolio is performing over time. Then we're going to take a look at the individual holdings, see if there's anything that is a good deal right now, and see if there's anything overvalued that I wouldn't touch. So as of right now, I know there are a couple stocks that are a good deal, but we did see a lot of green today, so some of those deals that we've been having over the past couple of weeks might not still be a deal. So they might not be a good buying opportunity at this point. So, and then of course we're going to look at the watch list with Costco and Berkshire. So jumping right in for today, we're up around $1,300 with about a 2.38% return, given the small loss of $63, $64 after market close. Then that 1 week mark, we are up about $961, about a 1.7% return. That 1 month mark, we're up $134, a 0.25% return. 3 month mark, we're up $6,800, up 13.7% in the green. Year to date is right around the same amount, up $6,600, about a 13.3% return. Then that 1 year mark, we are up $11,800, a nice around 26.5% return. That's great. And then of course, all time, we are up $29,937.54, a total cumulative return of 112.91%. So guys, I've been investing since April 9th of 2018. So there have been a couple of crashes, a couple of really bad on certain points in the market. Honestly, as of right now, just given the trajectory, the line that you see, I am guessing that there's not going to be a lot of deals within the portfolio, right? I think a lot of stocks did really well today. I don't know why. I haven't really looked at news. I haven't really been watching earnings reports. I kind of just set it and forget it and let the companies work their magic. But if there's a big news release on a company, I do check it out and I try to take advantage if it affects the stock negatively. But let's jump in and see how stocks did today. So Realty Income's up $1.42, a 2.5% gain today. We have 5 shares, $2.90 in market value. Average cost is around $52 per share, so definitely way out of my buying range here. 0.5% of the portfolio is in Realty Income. Today we're up $7. Total we're up $31 with a 12% return. So guys, I would consider buying this around the $52 mark or $53 possibly, but I don't want to buy it at near $60. To me, that's really high between the low and the high. This is pretty middle ground, but closer to the high. And my original average cost, I believe, is like $53 or $54. So I did have a higher average cost, but I want to keep it lower than 60, and it's closer to 60 than where I would like to purchase it. So as of right now, I wouldn't add to Realty Income, but it is one of my personal favorites. I do look at this company as my social security, essentially. It will just pay me every single month, and I will reinvest those dividends back into Realty or eventually maybe Visa or Google if I make that much passive income. But this is going to be that steady Eddie company. I don't expect it to have massive growth. I don't expect double-digit growth. I don't expect, like an NVIDIA type stock. I know this is a slow grower. I know it, is 2 to 3% a year. I'm fine with that. This is essentially my retirement stock. So this will be a larger position, but I think eventually my goal is to have it outpaced by Apple, Visa, Google, etc. So even though it's not going to be a core position, it's not going to be in the top 5, it's not going to be a main priority, this is one of those that I want to add to over time, and I wouldn't be surprised if for a while it eclipses something like Berkshire or maybe even Coca-Cola. But I will always add more to make sure that the dividend income at least matches my paycheck eventually. That's the goal for Realty Income, is to have this stock match my paycheck, and then everything else is just gravy. Next up, we got a Dividend King, a little bit below $60. Altria, ticker symbol MO, 320 shares, $19,000 of market value. Average cost is right around $47.30. Around 34% of the portfolio is in Altria. Today we are up we're at $570, 3% return. Total, we're up a little over $4,000 with a near 27% return. And then the real reason that I love this stock is because it's compounded the dividend very well over the past 4 or 5 years that I've owned it. The dividend is now, I believe, $1.02 per share, and that equals out to $320 per quarter every single time that I get paid. So as long as Apple stays below the, $300 mark, I can buy that forever. But the real beauty of it is with, say, Altria's dividend, what's left over after just buying a share of Apple, which is the goal, right? So I use this month's dividends to buy next month. But this month I transferred cash over. So I not only, and before this dividend was paid as well. So I already bought a share of Apple and I bought a share of Google. So now with this, payment at the end of the month, I can leave it in there. I could go ahead and buy another share of Google. I could add another share of Apple. I love that I'm able to put more cash into the portfolio because it is going to just start growing a lot faster, especially when I'm buying these high growth companies. So I might even splurge a little bit more on the next paycheck than I normally would and fork up money enough to get a Visa share. But we'll see. But the goal is 20 shares of Apple by the end of the year, and until the rest of the year, this is the first quarter that Altria is paying me. So as of right now, I have a guaranteed, as long as the dividend stays where it's at, 3 free shares of Apple from Altria. So with my current 12 share count, I'd have 15. So by the end of the year, I owe myself 5 shares of Apple, which I think is very doable. So the strategy is working, guys. It's used this month to buy next month, and my cash flow just keeps growing. So thank you to Altria and everybody that works there, all the shareholders, all the dividend growth has been amazing. So I have nothing but positive things to say about it. I know morally some people don't like the stock, but when you can go ahead and just say, whatever, I'm going to buy a share of Apple, I don't want that to change. So next up, we got Coca-Cola. This is one of my personal favorites. I have a Coca-Cola hat on right now. I drink it every single day. I had a can of it at work today. So as of right now, it's sitting at $71.62, up $1.25 today. 15 shares, $1,074 worth of market value. Average cost is about $60 per share. Almost 2% of the portfolio is in Coca-Cola. Today we're up $18. Total we're up $166 with an 18% return. And a dividend coming in on April 1st. Of $7.65. So guys, this is one of those that is just like Realty Income. I don't expect it to grow a lot. I'm owning this because I love the brand. I've had a lot of people on like Instagram, even like years ago, they were like, Coca-Cola is a no growth stock. You're wasting your time. I'm not in this for I'm not in this for like an Nvidia return, right? I'm not in this for a MasterCard return. I'm in this because I love the business. I understand the business and how it works and how it functions, and economically, I love how they have pricing power, right? I love how they can charge 12 to 15 cents more per 12 pack than Pepsi, right? I love that they have that. Now that's not immortal. They might overcharge and people might switch up, but people over time have been very loyal to this brand. It's been around over 100 years, and I want a piece of, I want exposure. I want a piece of that brand, right? So I am a firm Coca-Cola believer. The banner on my YouTube channel is Coca-Cola. So this is one of those that even though it might not have the same growth rate as a Google, Apple, Visa, etc., I want to own it, right? So it's a dividend king. I'm not super worried about it growing the dividend in the future, and it doesn't need to grow up very much. They have great cash flows. They grow a little bit year over year, and they're a very mature company that's rewarding shareholders through dividends. So I'm excited to own it for the future. And eventually, like Altria is buying Apple, eventually I would love Coca-Cola to buy AbbVie. That will take a while, but that's the goal, is this month to buy next month. Then next up, we got Apple at $221.76. This has gone up a little bit. So I bought a share Sunday, but it hit the account today. We have 12 shares now, $2,600 of market value. Average cost is around $218. 4.7% of the portfolio is in Apple. Today we're at $47. Total we're only at $44 with about a 1.6% return. So guys, this is one of my personal favorites. I love Apple products. I have a MacBook. I actually have a Samsung phone, but I would prefer an Apple. Because of personal reasons, I had to keep the Samsung, but I love the business. I love the ecosystem, and I do think services is going to smash everything else out of the water. It's already starting to happen. And when you see those segments, like if you look at even like 2020 to 2024, that segment, it's still small comparatively to like, the iPhone, AirPods, stuff like that. There's a lot, like wearables, there's a lot of different money generators for Apple, but I do think services is going to become a very key part, and I think that's something that's very overlooked. Everybody talks about their iPhone sales declining or iPhone sales not growing as fast. I don't. That's not what I think the future of Apple is. I think the future is people using their iPhones to buy, purchase, play games, etc. People live on their phones, and Apple is the biggest product in somebody's pocket, right? Apple is one of the most used companies. Like the iPhone's one of the most accessible products in the world. So if people are going to spend money on it, Apple gets a portion of that through through their ecosystem. I want a part of that ecosystem. So that's really why I want Apple to be the biggest position in the portfolio, is because I think people are overstating the lack of iPhone sales and underestimating how big services could be in the future. And honestly, if I'm wrong, they still make a crap ton on iPhones. They still made a crap ton on AirPods. They have so many different segments. I'm not worried about one of them slowing down, because Apple's slowing down, still making more money than companies like Walgreens or AT&T, right? And they have so much money on the balance sheet. I'm not worried about productivity and future cash flow when it comes to Apple, because even if they have a product that doesn't do well, or maybe they do have segments that are slowing down, I think that eventually segments is going to outpace what they're losing in iPhone sales, and I think services could be one of their, if not their biggest segment. So I have a little bit of a different take on Apple, because a lot of people were very negative. I think it was like in 2016 when the iPhone sales, they said they weren't reporting numbers anymore. I loved it, and honestly, I should have bought it back then, but I was dumb. So this is my retribution. This is me trying to correct that mistake. So Apple will be the single biggest position, and I'm excited to watch it keep growing. So at these levels, I would definitely be adding more Apple. And my goal is 20 shares by the end of the year. So it's March, April, May, June, July, August, September, October, November, December. So about one a month. If you factor in Altria, it has to be one for the next 5 months, and I think I could do that. So 20 shares of Apple is the goal by the end of the year. Hopefully, I hit that goal. Next up, we got AbbVie at 209. It's crazy that Apple and AbbVie are around the same price. But AbbVie's sitting at 209.52, up $4 today. 95 shares, $19K worth of market value. $95 per share is our average cost. 35% of the portfolio is in AbbVie. Today we're up $400. Total we're up $10,800 with a 120% return. So guys, this is by far the best performing individual stock in my entire portfolio. And I'm so glad that I bought it when I did. I bought it on some really shaky news, and I just held on to it because I believed in the company that they acquired. And they acquired the company that owned Botox. They had Humira, and I'm like, I feel like even if it is kind of messy to merge these, I feel like that the market is punishing AbbVie for making a good business decision. And when I did my intrinsic value calculation for AbbVie alone before they acquired all those assets, I thought they were worth around $75 to $80 a share. So, and I think it was Allergan. I thought they were worth about $100 per share, given Botox and like where I thought that was going to go. So I said total, I think they'd be around $200 a share is where I thought they'd be at. And I didn't even factor in the dividend growth. Like I thought accumulatively together, they were worth more than they were separately, right? And I think the growth rates for both of those drugs were going to be astronomical. And the overall company, after everything was settled, would be a lot stronger. And I think it worked out. The company's sitting around where I thought it would be once everything cleared. And the dividend's grown really nicely. So, AbbVie was a spinoff of Abbott Labs. And Abbott's a dividend king, I believe. So, AbbVie on shareholder calls, conference calls, they've said that they're very clear about that they want to grow the dividend and reward shareholders, do some share buybacks, but really focus on their pipeline. But they're not scared to bump their dividend up, which is great. That's what you want. You want to have a company that has enough cash flow and is smart enough to divide it up to grow the business while rewarding shareholders. Now, sometimes the dividend can be a bad thing because that means that they're putting less money into research and development when it comes to, especially drug companies. You want them to be researching and doing a lot of development when it comes to new drugs. But I think that they're doing a really good job with the loss of the patent of Humira. So I think they're doing really well with the cash flows. They, manage their money very well. They have a pretty clean balance sheet. They didn't go into massive debt to acquire the assets of Allergan. So overall, I think they did a really, really good business decision, and the company's been rewarded. So I'm glad I made that move. I talked to a lot of my friends when I bought that stock, and some of them were like, hey, it's pharmaceutical. I don't know, regulation, this, that, other thing. There was 20 reasons not to buy it. Everybody was saying, they're going to lose Humira in a couple of years, and it was a bad move to buy another company. Here we are with 120% return. And, the dividends pay me 150 a quarter. When I first started, I think it was like 80 a quarter. So, the stock's appreciated well. The dividend's done very well. And now I'm at a point that I'm very close to being able to buy a share of Google. If it stays around 160, I can buy a share of Google for the rest of my life with AbbVie. So AbbVie's just like Altria. Altria buys Apple. AbbVie buys Google, right? And then eventually Visa will buy Coca-Cola. Coke will buy AbbVie, and then Apple will eventually buy Visa, which will take forever, but that's the goal. So AbbVie's very close to achieving the goal that I have set out for the position, which is to just buy me a share of Google every single quarter. So I'm excited about that. Next up, we got Visa, which I wish would stay down. It's up $7 today. So it must have had some good news. I haven't been paying attention to it. I try not to pay attention to news, but I'm sure it's, sometimes it's good, sometimes it's bad. I try to ignore the good news and only focus on the bad because I want a really good buying opportunity with some of these high quality positions. But I have 35 shares of Visa, $12,000 of market value. Average cost is around $350, so it's still in a buying position for me. 21% of the portfolio is in Visa. Today we're up $233, around a 2% return. And then total we're up 65 with a 0.5% return. So this is very close to my average cost and still in buying range for me. I would probably cut off the buying rate at around 355 to 360. But this is going to be the second biggest position, and I would not be irritated or mad. I'd actually be kind of excited if it overtook Apple eventually. So just be ready, because eventually, once Apple is where I want it to be as a position, I will be heavily adding to Visa. And if there are any big dips, I will try to get a couple more shares of Visa if I can afford it. And then, of course, we got Google at 155. We've got 7 shares, so I just bought a share yesterday. We have a little over $1,000 of market value. Average cost is $187.86. Around 2% of the portfolios in Google. 46 cents in the green today, $200 down with about a 17% loss. So still the best buy for me is Google by far. And I could have bought another share of Google yesterday with the Apple money, but I really want to get to 20 shares. So I'm trying to stay as aggressive and as tunnel visioned as I can, which sometimes means you do have to miss out on a really good opportunity. So I do think Apple's a good opportunity, but I do think Google's a better one. But if my goal was to get to 20 shares of Google, you can trust that I would be buying a lot of Google right now. So, and then of course, I think Costco is a buy. I said under 1,000. So if it's, $9.50, I'm definitely adding. But the people who have owned it for, bought it recently have been making a killing. So, if you bought it within the past, week, you're up 3%, which is $32, which isn't a lot, but $15 today, that's still a nice gain. I mean, it's not crazy numbers, but year to date, you're up $30. But if you've held it for over a year, you've made 30% on your money. So long term, I love Costco. It's going to be one of those that I add because I want to own a share for Charlie Munger, to be completely honest with you. But once he talked about it in the Berkshire meetings, I did my research on it, and it's a very low margin business, but I love, the big thing for me is they know how to manage their business so well. And I know that sounds dumb because, of course, that's what they get paid to do. There's so many businesses that get stopped up by a bad management team. People that don't know how to spend their cash wisely in their, in their businesses. Look at AT&T. They went and bought a fucking streaming service that had nothing to do with their core business of telecom. They went and bought DirecTV, which again, I think they were trying to make it all one package. They were trying to centralize their business, but they just spent a crap ton of money, destroyed their balance sheet. They're in a debt heavy, that heavy type of business. The economics on it are not very not very good. People need phone service, but you don't need to go broke trying to provide that, right? But that's the industry. And Costco's in retail. They're a wholesale, but they're a very low margin business, so they have to be very careful about how they spend their money because they could overspend and get screwed. But what I do like is they have excess cash on their balance sheet, which is something some companies don't have, but well-managed companies do. And one of the things that I love about Costco is when they have excess cash on calls, they have said, we don't know how to spend this in an intelligent way in our business. So we're going to reward shareholders with a $10 dividend or a $5 dividend. We're just going to, since we can't use the money in a healthy way in our business, we're not going to just spend cash frivolously and be stupid about it. We're going to give it to shareholders because it benefits them more in their pocket than it does us making another location, right? And I love that about their business. I love that about their management team is they're honest, right? They just say, we can't figure out a good way to spend $12 a share. Here you go. And that's a sign of a good management team, because what you don't want is companies like, say, Apple or Google. I know Google just bought a company, and I do think it was a good strategic buy. But you don't want to just have companies buying up other companies frivolously, right? Like Costco, like if Costco said, oh, we're going to buy this meat packing plant, that kind of makes sense because they do grocery, right? But if they said, we're going to buy, I don't know, like a microchip company, you'd probably be like, what? Like an ADM or something. That'd be kind of weird, right? So I love that Costco's very, very focused and very honest about what they plan on doing and how they plan on spending their money, and they're very cautious about capital expenditures. So that's what I love. And in the industry that they're in, they have to be very smart about how they spend their money. I mean, every business does, right? You don't want to have your management team making stupid decisions, but when it comes to the choices to pay special dividends, I don't want to own Costco because of that. But not because they're paying me a special dividend. I want to own Costco because I believe in the management team, because they're very, very competent in how they manage their capital, right? So that's the difference for me when it comes to, like, that's why I would buy Costco over like Walmart, Home Depot. I've even looked at Lowe's. I like Costco better. And then next up we got Berkshire, which is my favorite insurance company. I guys, there's so many businesses that I like that I use from Berkshire. If I would save money, I'd use Geico. I can't. I tried and I don't save money. So, but I'm a guy and I'm younger, so that's probably why. But eventually, I would love to have Geico as my insurance company, for my car insurance. But guys, See's Candy, Dairy Queen, they have. I love See's Candy. It's my favorite candy in the entire world. Like, I've gone to the Berkshire meeting. Like, this is the fourth year I think in a row, and it is my favorite, like, thing to do every year. So there are a couple restaurants we really like there. We like getting the shareholder discounts. I don't own a share yet, but my stepdad does. So he invites us to go, and my stepdad and I go to the meeting, and my mom and my girlfriend go shopping. And there's a couple specialty stores that are really cool in Omaha. So I just love being around like-minded people. And honestly, I think he's picked really good successors, right? Greg Abel and Ajit Jain. Ajit's ran that insurance company flawlessly for years, and Greg Abel has ran everything else, in a in a like-minded way to Charlie and Warren. And I don't think that there's anybody better that they could have picked. His answers were a little bit generic, but given the fact that he's kind of getting transitioned into the role of Warren Buffett, of being this, co-CEO, co-chairman, you're never going to have somebody that's Charlie, and you're never going to have somebody that's Warren, right? So Greg has really big shoes to fill, and Greg and Ajit do as like a duo, if that's how they go forward. I'm not sure if they're both kind of running it. From the sounds of it, Greg Abel's doing everything but insurance, and Ajit's doing insurance. I don't know how they're going to do capital allocation. I'm interested in to see how Ted and Todd, those are the smaller managers that Buffett has on his payroll that do the smaller transactions comparatively to Buffett. So as of right now, Buffett and Ted and Todd are doing the capital allocation, and Greg and Ajit are running the businesses. So I'm interested to see what it will be like when Buffett goes and who they appoint to do capital allocation, because that's very important. But as of right now, they have a crap ton of cash on the balance sheet. What I'm guessing is they're waiting for a COVID drop, and they're going to buy businesses that are affected by whatever happens next, and they'll try to take advantage and make a crap ton of money for their shareholders. So, and I'm excited. I want to be one of those shareholders. So, by the end of the year, I do have a goal to at least have one share of Berkshire. I know it's not much, but I want a little piece of the pie. But my goal is to be able to have a share a year, right? So I've invested since 2018, so 19, 20, 21, 22, 23, 24, 25. This is 7 years. So I own myself 7 shares of Berkshire. I don't have $3,500 to just throw into Berkshire Hathaway stock. So as of right now, I'm going to try to chip away at it just like I'm doing with Apple. So originally the goal was to buy it every Christmas, so I might just start doing that. If I get any money towards Christmas, or if I have, a bonus or something like that at work, I'll be throwing it into Berkshire stock once Apple's where I want it. So, but with that being said, guys, I just want to say thank you so much for watching. Remember to hit the like button on the video. That does help a lot. It helps the channel, and help me out by hitting subscribe, because that helps more people see the channel. And if you want to see me become, right now I'm a $50,000-aire, but I want to try to become a millionaire. So that's the goal. Is long term, just going to keep putting more money in and growing. And, I hope you guys join me for that journey. So thank you so much for watching, and I will see you guys tomorrow with another Robinhood portfolio update. Take care, guys.